Hi everybody, welcome back to the continuing series of study guide videos for exam number 2. Let's move on to question number 2. Which of the following would be disclosed in the Summary of Significant Accounting Policies Disclosure Note? Would it be considering composition of long-term debt and disclosure about depreciation method? Would it be A, the composition of long-term debt would not be included in the significant accounting policies footnote, but the depreciation method would? Or B, would we include the composition of long-term debt in the significant accounting policies footnote, but not include the information about the depreciation method? Or C, would we include both information about the composition of long-term debt and the depreciation method in the Summary of Significant Accounting Policies footnote? Or D, would we include neither of those pieces of information in the Significant Accounting Policies Disclosure footnote? Please pause your video while you consider this question, then carefully choose your answer and start the video again to check your work. By the way, if you want to go thumbing through Chapter 3 to find these answers while you have the video paused, that is totally okay. The correct answer is option A. The choice of depreciation method is definitely an accounting policy and must be disclosed in the Summary of Significant Accounting Policies footnote. But the composition of long-term debt must be disclosed, but not as an accounting policy. It's information that needs to be disclosed in a spot other than a footnote that describes the significant accounting policies that the company follows. Question number 3. Which is not a subsequent event for an entity with a December 31st, 20X1 year end? So we're looking for something that is not a subsequent event that requires disclosure. Would it be A, an issuance of bonds payable by the company in January 20X2, so the month following the year end? Or would it be a major uncertainty that existed at December 31st, 20X1, but was resolved in January 20X2 before the financial statements were released? Or number C, would it be an acquisition of another company in January 20X2 before the financial statements are released? Or would it be D, a change in an estimated useful lives of equipment, and that change was decided upon and made in January 20X2? Please pause this video while you carefully consider this question and choose your answer. Then start the video again to check your work. Option D is the correct answer. A change in the estimated useful life of equipment is not a subsequent event. It is simply a change in accounting estimate. All of the other are subsequent events that must be described in the subsequent events footnote if the dollar amounts are material. Let's take another bonus break. The scavenger hunt words for this video are favorite way. Favorite way. W-A-Y, way. Okay, question number 4. An example of fraud would be A, knowingly classifying a material long-term receivable as a current receivable, or B, forgetting to accrue salaries and wages payable, or C, buying raw materials from an affiliated company, or D, issuing a purchase order without first securing bids. Which one of those items, A, B, C, or D, would be an example of fraud? Fraud is defined as the intentional misappropriation of assets or incorrect financial reporting. So option A is fraud, knowingly classifying a material long-term receivable as a current receivable. Certainly makes the balance sheet look a lot nicer, but it is fraudulent because that receivable should be classified as a long-term receivable, and the accountant or management knowingly misclassified that to make the financial statements look better. Option B, forgetting to accrue salaries and wages, is an error. Option C, buying raw materials from an affiliated company, is a related party transaction. And failing to secure bids before issuing a purchase order is nothing. I mean, there is no requirement in GAAP that requires a company to obtain bids. So it's none of these. It's not fraud. It's not an error. It's not a related party transaction. It's just something that happened. Has virtually no financial impact. Question number 5. An example of an error would be A, counting inventory item twice when taking physical inventory, or B, purchasing inventory from a related party, or C, holding back invoices so that accounts payable are understated, or D, receiving kickbacks in exchange for issuing a purchase order to a vendor. Which one of those items is an error? Please pause the video while you carefully consider the question and choose your answer. Then start the video again to check your work. Option A is an error. Counting an inventory item twice when taking physical inventory is definitely an error. Option B is a related party transaction. Option C is fraud. Holding back invoices so that accounts payable are understated is a fraudulent act. And number D is an illegal act. Receiving kickbacks in exchange for issuing purchase orders to a vendor is an illegal act.